Good day, investors. In this video, we're taking a closer look at Newmont, ticker symbol NEM. The company just released its Q1 earnings, and honestly, this was a massive quarter, driven by strong gold prices and incredible cash flow generation. So in this video, we'll break down the earnings, take a look at the fundamentals, and then go over the valuation. And finally, I'll give you my personal take on whether Newmont stock is still a good investment right now. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. Now, if we start with the key highlights from the quarter, Newmont produced around 1.3 million ounces of gold, along with additional copper and silver from its diversified portfolio. The company generated $3.1 billion in free cash flow, which is a record, showing just how strong margins are in the current gold environment. On top of that, Newmont returned $2.7 billion to shareholders through dividends and buybacks, which is very impressive. Adjusted net income came in at $2.90 per share, also a record level. The company also repurchased $2.4 billion worth of shares and announced a new $6 billion buyback program. And importantly, management confirmed they are on track to meet full-year 2026 guidance, while keeping costs under control despite macro uncertainty. So overall, this was a very strong quarter, driven by high gold prices and solid execution. Now, building on that, let's take a closer look at the key financial figures from the quarter. Newmont delivered $5.2 billion in adjusted EBITDA, which highlights very strong underlying profitability. GAAP net income came in at around $3 per share, while adjusted net income was $2.90 per share, showing solid and consistent earnings performance. Now, one of the biggest drivers here was the gold price. The company realized an average price of around $4,900 per ounce, which is extremely high and a major tailwind for the business. And when you combine that with all-in sustaining costs of around $1,029 per ounce, you can see that margins are extremely strong at current gold prices. Looking at cash flow. Cash from operations reached $3.8 billion, and free cash flow came in at $3.1 billion, which really highlights just how much cash this business is generating right now. On the balance sheet, Newmont is also in a very strong position, with around $8.8 billion in cash and cash equivalents. So when you put all of this together, Newmont is currently operating with very strong profitability, massive cash flow, and a solid balance sheet, all supported by a favorable gold price environment. Now, turning to capital allocation, this is where we get a better sense of management's overall strategy. Starting with sustaining capital, the company spent around $381 million in the quarter, and they're targeting roughly $1.95 billion for full year 2026, so spending is expected to ramp up going forward. When it comes to dividends, Newmont paid out about $282 million, and the company is targeting around $1.1 billion annually, with a quarterly dividend of roughly 26 cents per share. On the growth side, development capital came in at around $239 million, with a full-year target of about $1.4 billion, showing continued investment into future production and long-term projects. Looking at the balance sheet, the company is in a net cash position of about $3.2 billion, compared to a target of around $1 billion, which gives it a strong financial cushion. And then, of course, share buybacks. Newmont repurchased about $2.4 billion worth of shares and announced a new $6 billion buyback authorization going forward. So when you step back and look at the overall capital allocation strategy, the company is investing in growth, maintaining a strong balance sheet, and returning significant capital to shareholders. And that's exactly what you want to see from a mature commodity company at this stage of the cycle. Now let's take a closer look at the production outlook. Newmont's gold production is expected to remain relatively stable, moving from around 5.6 million ounces to about 5.3 million ounces. In the near term, we do see some pressure from lower grades and planned mine sequencing, which is fairly normal in mining. But this is partially offset by new production coming online, like Ahafo North, along with ongoing efficiency improvements across the portfolio. So when you look at this, it's not really a concern. It's more about timing and operational planning rather than any structural weakness in the business. Now, another important factor to understand here is the cost side of the business. Newmont's all-in sustaining costs are expected to increase from around $1,339 to about $1,680 per ounce. The main drivers behind this are lower production volumes, higher sustaining capital spending, and also higher royalties and taxes, which naturally increase as gold prices go higher. There are some offsets, including currency movements and ongoing efficiency improvements, which help keep costs somewhat under control. So yes, costs are moving higher, and that's something to keep an eye on. But it's important to keep this in context. With gold prices still at very elevated levels, Newmont is still generating very strong margins, despite the increase in costs. So this really comes down to the relationship between gold prices and costs, and right now, that spread is still very favorable for the company. Now, if we look at guidance for the year going forward, Newmont is guiding for around $1.95 billion in sustaining capital and about $1.4 billion in development capital for 2026. On top of that, you also have significant depreciation of roughly $2.8 billion, along with other ongoing expenses and a tax rate of around 33%. So this clearly shows that Newmont is a highly capital-intensive business, which is typical for large-scale mining companies. But at the same time, when gold prices are strong, the company is still able to generate very significant cash flow, as we've seen this quarter. So after looking at the earnings and fundamentals, let's now shift our focus to valuation and what analysts are expecting going forward. Currently, according to stock analysis data, analysts have a consensus rating of strong buy on Newmont. The average price target sits at around $122 per share, which suggests only a modest upside of roughly 1% from current levels. However, when you look at the range of estimates, there's quite a bit of dispersion. The low target is around $72, while the high target goes up to about $176 per share, indicating potential upside of over 45% from current levels. So what this tells us is that while the long-term outlook remains positive, there's also uncertainty around where gold prices go from here, which directly impacts valuation. Now, taking a closer look at the stock performance, we can see the current setup more clearly. Newmont is trading at around $120 per share, giving it a market cap of roughly $128 billion. Looking at the valuation multiples, the stock is trading at a PE ratio of around 15.7, with a forward PE closer to 12, which is quite low given the current profitability. At the same time, the company has delivered very strong growth, with revenue up around 27% and net income up nearly 67%. The stock also pays a small dividend of around $1.04 per share, giving it a yield of roughly 0.86%, which adds a modest income component for investors. And if we zoom out, the stock is also up over 120% over the past year, showing just how strong the momentum has been, largely driven by rising gold prices. So from a valuation standpoint, Newmont looks relatively attractive at around 12 times forward earnings, especially considering the current earnings power and strong cash flow generation. So when we bring everything together, Newmont just delivered a very strong quarter, driven by higher gold prices, solid production, and excellent cash flow generation. The company is now clearly showing strong operating leverage, meaning when gold prices rise, margins expand very quickly, and that's exactly what we're seeing right now. On top of that, capital returns were a major highlight, with $2.7 billion returned to shareholders and a new $6 billion buyback program, which shows strong confidence from management. Even though there were some operational headwinds during the quarter, Newmont still reaffirmed full-year guidance. And looking ahead, production is expected to improve beyond 2026. However, Q1 was exceptionally strong, and the next quarter will likely be weaker due to higher costs and temporary production impacts. And of course, the biggest variable here remains gold prices, which will ultimately drive earnings and valuation. So, in my opinion, Newmont remains a very attractive gold stock even at current levels, especially for investors looking for exposure to rising gold prices, strong free cash flow, dividends, and buybacks. And the reason I say that is because I do see gold prices potentially moving higher, driven by ongoing inflation pressures, high government debt levels, and continued central bank demand for gold as a store of value. In that type of macro environment, gold tends to perform well, and Newmont, as a low-cost producer, is positioned to benefit significantly. So overall, while valuation should always be considered, the long-term setup here still looks very compelling in my opinion. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.